Arulselvan is the President and CFO at Cholamandalam Finance and joins in right now to talk about their quarterly performance. Good to have you on board. And despite Q1 being seasonally weak, the AUM has been healthy. Will you be revisiting your guidance now, and what segments are driving your growth?
We have grown across all the verticals. If you look at vehicle finance, has grown by around 32%, and loan against property has also grown by around 32%. Home loan is a new business, is an old business, but we are growing in other parts of the country. Earlier, we were focusing more on, south and a little bit on west. Now we are going into north and east, so it has grown substantially, registering a growth of around 138%. The small and medium enterprise, the SME business, that has also grown substantially by around 100%. These are the new businesses. So all the new businesses are grown by around almost 100% plus because their base is small. But the existing business are also done well by registering a reasonably good growth of around 30% plus. So all put together has delivered this growth, and we expect the momentum to continue.
Sure, so overall sentiment looks good with healthy disbursements, but of late there have been reports of inventory piling up at dealerships. What's your sense on the credit demand going forward, especially in vehicle finance?
See, if you look at it, we are in the entire gamut of vehicle finance, right from heavies, lights, mini lights, tractors, sun construction equipment, two-wheeler, cars, MUVs, etc. And our focus has been on more on the rural side with regard to the passenger vehicle, two-wheeler, tractors, and the mini lights and the lights. So our demand has seen reasonably good growth, as I was telling earlier. And we are also into used segment, and which is also showing a healthy growth because the price of new vehicles are more expensive, and the segments we operate in, the customer segments we operate in, are price sensitive. So to that extent, they are now we're seeing a little bit of a shift towards the used, and we see the demand perking up there. This is more pronounced because of the price variance between a BS6 vehicle and the BS4 vehicles, which are now coming up as used vehicles in the overall industry. So we see we don't see any fall in growth in the coming quarters. But as I said, let us wait for the Q2 to get completed. Then we will be much more confident in committing some growth numbers.
So, given that your margins have been hit this quarter on account of the rising cost of funds, what's your sense as to how cost of funds could shape up for the rest of the year, and are margins going to moderate further?
See, our expectation is the cost of funds, the peak of the cycle has been, we have already faced it. From here, unless something drastically different happens, because still there are uncertainties, whether with regard to the Fed rates or with regard to our own inflation, etc. But for those, events, I expect cost of funds to moderate going forward. The cost of funds would be at similar levels in Q2, and in Q3, Q4, we should see some reduction. Parallelly, the vehicle finance book, which has the largest fixed rate book, would also be slowly changing its interest yield, as an overall book, with the newer book coming in at higher yields. So that would make it a better yield, producing product, which would thereby improve the NIM in the coming quarters. Right now, we are in the cusp of where the old book is still a large part of the vehicle finance book, which is having a lower yield, while the cost of fund impact has happened quite rapidly. So thereby there has been little time to sort of adjust the yields on the vehicle finance book. In the rest of the portfolios, we already increased the rates because these are floating rate books.
Sure, there's obviously a lag between the asset and the liability repricing given the nature of your loans, right? Especially on vehicle financing, like you mentioned. But how many more quarters do you think till the overall book is able to reflect the new rates?
See, it will take at least 3 to 4 quarters for the vehicle finance to completely or predominantly become the new rate book. We have already crossed around 3 to 4 quarters, so it will be another 4 quarters because it will take anywhere between 8 to 16 quarters for the end to end of a portfolio to run down. But somewhere in the mid of in 8 quarters, the mix will change, that the larger part of the portfolio would be the newer rate portfolios. The other point to note also is, since we are growing robustly there, the growth would also fuel the shift quite fast.
And given that provisions have tripled, your asset quality has also mildly deteriorated sequentially. Are you seeing some stress on your portfolio, and what's the reason for the provisions having risen so sharply?
See, there are two aspects to it. One is, I mean, we had always been also on the other side questioned our provision coverage is always low. So we have kept it at the same levels only. If you look at the provision coverage, it's been at the same level as what we closed the March. So I don't see that, that this has been a very large shift in provision, and certainly there has been no triggers to make any extra provisions in this quarter. So what's been running through is, we have in March, when we converted the new PDLGDs. Every year we change our PDLGDs in March, so that taking the last 5 years or 6 years average depending on the product. So as you know, the PD-LGDs of all the products changed, to some extent, because the loss levels during the COVID period were higher. So to that extent, the PD-LGD shift is, will be reflected in the provisioning that we will be creating as we move forward. So this part will again iron out as we get into further years of better performance, so that this anomaly of this COVID 2 years of higher provisioning is sort of ironed out.
So you're not seeing any fresh triggers to make higher provisioning from here on, but overall, how's the asset quality shaping up, especially on the incremental book?
See, the asset quality has been quite good. Actually, I would say normally in a pre-COVID period, if you look at it, Q1, the asset quality will slightly deteriorate because there would have been a lot of collection efforts going in Q4 because of the year end, etc. So Q1 will always have a slightly reversal of asset quality trend. Actually, in our case, you would have seen that we have just moved the stage 3 by 5 bips, and as a matter of fact, the RBI NPA norms we have reduced from where we were at, from 4.6 to 4.3. Sorry. So asset quality is performing much better and than what it was pre-COVID in a normal turn of quarter-on-quarter basis, which used to happen in a pre-COVID scenario. And we expect this to further improve in Q2, Q3, etc. Q2 the improvement would be moderate, because these are months of rainy seasons, as well as inauspicious months where the borrowers earning capacity is a little bit challenged because of their the rains and the inauspicious months. But in Q3 and Q4, because of festivities as well as agricultural harvesting, etc., the earning potential sort of increases substantially, and so that's when you see much better collection and substantial reductions in the stage 3 and and then the NPA numbers, which we again expect to happen if the rainfalls and the other aspects of the economy stays put.
And could you also tell us how collection efforts are panning out specifically towards the delinquent accounts?
See, the collection efforts are, more than 110% during this quarter also. And that is what is reflected in the NPA numbers. Both in stage 2 and stage 3, you would have seen reductions happening as compared to the March numbers. If you look at it from a percentage point of view, if you look at the stage 3, it has moved up marginally by 5 bips, and in the case of stage 2, it has moved down from 3.68 to 3.51. So this is the reflection of the collection effort, and so I would say that the collection efforts have been continuously, at its peak during this quarter, as in any other quarter. See, the Chola's strength is its collection, and I think that's what keeps us, good at keeping our, NPAs as well as the stage 3 in a much more controlled manner as compared to players in similar domain.
Okay, so on that note, we let you go. Appreciate you joining us on the show.